If I told you a publicly traded company was secretly trying to corner 5% of the entire global supply of Ethereum, while smart money quietly keeps stacking shares behind the scenes, you would probably assume their stock has already become a rocket ship headed straight to the moon. You might even assume it is the next massive crypto wealth creation machine the market has ever produced. But here is the twist the headlines never tell you, and this is where the real story begins. The title of today's video says it all: BMNR stock, the hidden reason smart money keeps accumulating. And yes, we are about to expose exactly what that hidden reason truly is, layer by layer, number by number. Yet the prevailing market narrative around BitMine Immersion Technologies, ticker BMNR, is overflowing with this exact type of unbridled optimism. So what if that story is actually blinding investors to a much harsher structural reality hiding just beneath the surface? By the end of this breakdown, you will know whether this is a generational opportunity worth buying tomorrow morning or a carefully constructed value trap engineered to hollow out patient retail holders. And before we go any further, if you love digging into the stories Wall Street does not want you to see, smash that like button and tap subscribe so the next deep dive lands directly in your inbox. That all sounds incredibly impressive, right? Until you actually look at how they are pulling this off. Right now, BMNR boasts a staggering treasury of 5.78 million Ethereum, giving them an estimated value somewhere between $10.9 and $11.5 billion. Bulls, led by Chairman Tom Lee, are enthusiastically comparing BMNR today to Amazon right before the AWS explosion, or Nvidia right before the AI boom transformed an entire industry. And the revenue engine honestly looks phenomenal on paper. They are projecting annualized staking yields somewhere between $235 and $290 million. Add in passive flow catalysts from their recent inclusion in the Russell 1000 index, and on the surface, the company looks like an unstoppable crypto juggernaut sailing toward infinity. But before you get too bullish, there is another layer to this entire picture that most retail investors are completely missing. To build an $11.5 billion treasury, you obviously need capital. Massive amounts of capital. And BMNR did not fund this stockpile through operational cash flow the way a healthy business would. They funded it by treating their common stock like a limitless ATM machine at a casino. To acquire those assets, the company aggressively expanded its share count from roughly 232 million shares all the way up to nearly 600 million shares over the past year alone. That is a staggering year-over-year equity dilution of over 9,000%. So yes, you are technically getting the Ethereum, but your personal slice of the pie is shrinking at a truly breathtaking pace. Could there be a day when that dilution spiral finally breaks the entire structure? That is exactly the question we are about to pressure test. Here is where the story starts to get even more complicated, especially when we crack open the balance sheet. When we look at profitability, we see a massive disconnect between optics and reality. Top-line optics look shiny, with Q3 revenues jumping all the way up to $46.5 million. But the bottom-line reality is absolutely brutal. A net loss of $83.6 million for the quarter and a trailing 12-month net loss of roughly $8.8 billion. Furthermore, when you actually dig into their filings, you find $298.6 million in 6-month SG&A overhead, driven heavily by stock-based compensation flowing directly to insiders. Management is handsomely enriching themselves, effectively acting as a very real dilution drain masquerading as operational growth. How long can that drain continue before shareholders finally revolt? Stick around, because the next lens changes literally everything. At first glance, an $8.8 billion loss seems like an immediate deal breaker. But let's change our lens for just 1 second. If you view BMNR through a traditional software or growth lens, trading at an astronomical price to sales multiple of 152 to 164 times, the stock looks horribly overvalued by every textbook metric on Wall Street. But applying GAAP net income to a company operating essentially as a digital asset trust is a fundamental category error. That $8.8 billion paper loss is overwhelmingly driven by non-cash, unrealized crypto markdowns, not operational cash burn, destroying the underlying business. When you evaluate them correctly using a price-to-book ratio, they are actually trading at a rational 0.8 to 0.9 times multiple. Curious how the exact same company can look like a moonshot and a value play at the exact same moment? That contradiction is exactly where the smart money lives. However, just as you start to feel comfortable with the valuation, another hidden obstacle quietly intercepts the cash flow. BMNR has a massive preferred dividend intercept sitting on top of the common equity, and almost nobody is talking about it. To fund operations without immediately diluting common shares yet again, they issued $273.8 million in a 9.5% Series A perpetual preferred stock. This introduces a senior weekly cash dividend burden of roughly $33.25 million every single year. And this preferred dividend absolutely must be serviced before common shareholders see a single dime of that yield. The common equity is effectively starved of income until this massive intercept is cleared. What happens if the preferred holders decide to convert at the worst possible moment? That tail risk alone could completely redefine the entire trade. And that brings us directly to a few classic red flags that growth investors are conveniently choosing to ignore. From a governance perspective, the company recently flagged ineffective internal and disclosure controls and abruptly switched their auditor to KPMG. These are textbook accounting red flags seasoned investors learn to spot in their sleep. Furthermore, management loves hyping up their moonshot portfolio, including a $180 million stake in Beast Industries and a $69 million stake in Aitco Holdings, which has loose OpenAI ties the bulls love to mention. But as disciplined analysts, we have to assign a near-zero valuation premium to these illiquid private bets. When the core vehicle struggles to translate staking yield into actual operating profit, these moonshots are just secondary noise distracting from the real numbers. Could those private bets ever actually become the next 20x story? Almost certainly not, and here is exactly why that matters. Despite all of these risks, the sheer weight of their assets creates a mathematical floor that the market simply cannot ignore. Here is the structural opportunity that the average retail investor is completely missing. Because retail sentiment is so fatigued by the constant dilution headlines, the stock is actually dragged below its gross asset value. The spot net asset liquidation floor, meaning the raw liquidation value of the Ethereum they hold per share, currently sits between $17.10 and $19.38. With recent trading prices hovering around $16.59, investors are mathematically acquiring Ethereum at a discount to spot. How long can Wall Street keep that discount wide open? Probably not as long as most people think. This exact pricing discrepancy is driving a massive wedge between who is buying and who is dumping. This disconnect has created a fascinating sentiment divergence across the entire market. The smart money is quietly accumulating. Institutional heavyweights like Cathie Wood's ARK, Founders Fund, Bill Miller 3, and a wave of ETFs now control roughly 20% of the entire float, driven by index inclusion and sheer NAV arbitrage pressure. Meanwhile, retail sentiment is souring at an alarming pace. Jump on platforms like StockWits, and you will see absolute exhaustion. Retail is frustrated by the glaring gap between management's hypergrowth promises and the totally flat, sideways price action that refuses to break out. Could retail capitulation actually be the launchpad the institutions have been quietly waiting for? Many of these retail traders are holding on for one specific reason, but the data says they are chasing a ghost. Social media is absolutely flooded with hype about a massive short squeeze, pointing to 46.31 million shares sold short. But let's debunk this illusion right here, right now. BMNR trades at a massive average daily volume of 35 to 40 million shares every single session. Because of this immense liquidity, the short interest ratio, otherwise known as days to cover, sits at a minuscule 0.89 to 1.1 days. The structural reality is that institutional liquidity completely neutralizes any meaningful squeeze risk. Shorts can comfortably cover their entire position in a single trading session without even breaking a sweat. So what then? Is actually controlling the price action day to day? That brings us to the mechanical forces quietly trapping the stock in a range. The stock is currently trapped by raw market mechanics, and this part rarely gets explained. BMNR recently redirected $86 million to buy back 5.5 million shares and that created an upward force, pushing the stock from $13 all the way up into the mid-16s. But this momentum hit a brutal brick wall almost immediately. There is a massive options max pain concentration sitting at the $16 strike, with heavy call resistance extending all the way up to 17.50. Market makers are structurally forced to sell into these rallies to maintain delta-neutral books, effectively trapping the stock in a painfully tight range. What breaks that ceiling first, a crypto rally or a sharp company catalyst? And that brings us to the one metric that actually determines whether this entire business model survives long-term. The true floor for this stock is not based on any traditional valuation multiple. It is based entirely on the spot price of the underlying asset. BMNR is heavily levered, yes, but it is operationally secure under one very specific structural condition. The company can comfortably fund its operations and even service that $33.25 million preferred dividend intercept without forcing further dilution, only as long as spot Ethereum stays comfortably above the $1,200 to $1,400 range. So the entire investment thesis quietly collapses if that level ever breaks with conviction. What if BlackRock suddenly pushes spot Ethereum below that band tomorrow? You have to know your real risk before you click buy. When we finally put all of this data together on one clean canvas, a highly predictable trading channel emerges. Here is the BMNR trading boundary map, and it is brutally honest. On the downside, you have a structural NAV floor sitting around $12 to $13, supported strictly by the raw liquidation value of their Ethereum treasury. On the upside, you have a max pain and resistance ceiling near $25, capped by structural selling pressure and historical patterns of share dilution. Within this channel, the stock's price action moves entirely at the whim of spot Ethereum prices and management's restraint regarding future stock offerings. Where do you honestly think this stock closes 12 months from now? That answer says everything about your conviction. So, what is the final verdict for investors seriously weighing this opportunity right now? It is finally time to discard the hype and discard the extreme bear case entirely. BMNR is not a moonshot that is going to skyrocket to $5,000 a share. Those wild estimates completely ignore the brutal realities of 9,000% dilution and paralyzing preferred dividends. But it is also definitely not a dying, cash-burning legacy miner headed for zero. The structural truth is that BMNR is a heavily levered, range-bound proxy for Ethereum itself. It offers discounted asset accumulation for those patient investors who truly understand the boundaries and respect the risks. Ultimately, your entire investment thesis boils down to one simple, unavoidable dependency. At the end of the day, BMNR structurally punishes anyone expecting a sudden, unhindered short squeeze. But if you are a patient investor who genuinely believes the spot price of Ethereum will remain comfortably above $1,200, you are looking at a highly liquid, institutionally backed digital asset trust trading at a rare discount to its underlying book value. Before we wrap up, here is a brief financial disclaimer. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security. All figures discussed are based on publicly available data at the time of recording, and markets can change rapidly without warning. Always do your own due diligence, consult a licensed financial professional, and never invest money you cannot afford to lose. Past performance never guarantees future results. All right, now let's bring this home for good. Drop a comment below with one honest answer. Do you think spot Ethereum can hold above $1,200 through the next major Fed cycle, or is the BMNR dilution spiral eventually going to crack the NAV floor wide open? I want your honest, no-fluff take in writing. If this breakdown sharpened your edge, smash like, subscribe for the next institutional teardown, and share this with one trader who still thinks BMNR is a guaranteed squeeze. I will see you in the next